If you live outside the state of Arizona and own an investment property here in the Phoenix metropolitan area, I'm about to walk you through 6 things about the 1031 exchange that most agents never explain. The deadline people get wrong, the rule that says you legally can't touch your own sale money, the word boot and how it can trigger a surprise tax bill inside of a successful exchange, what actually counts as like kind, what to do if you find your next property before you sold this one. Option almost nobody tells tired landlords about that keeps your tax deferral without ever taking another tenant call. And lastly, if and when you can use tax deferred property as a primary residence. So let's get into it. Quick note before we start, I'm a real estate agent, not a CPA or an attorney. Everything in this video is general information, not tax advice for your specific situation. Always talk to a tax professional and a qualified intermediary before you act on any of this. And that's how you keep yourself from getting sued. At least I hope. Here's the basic idea of a 1031 exchange. When you sell a rental property or investment property, you usually owe capital gains tax. And if you've depreciated it, you owe depreciation recapture as well. A 1031 exchange lets you roll your gain into a new investment property and put off that tax bill instead of paying it the year you sell. It's not a loophole, it's a real tool built into the tax code, but it only works if you follow the rules exactly. And most of the ways people mess it up happen in places nobody warned them about. You probably heard the deadlines, 45 days after closing to identify a replacement property in writing. 180 days to close on it. Not 180 days after the 45, 180 days total. No extensions, no exceptions. Here's the part almost nobody explains. How do you actually identify a property? The IRS gives you 3 ways to do it, and you only need to satisfy one. The 3 property rule lets you name up to 3 possible replacement properties of any value, as long as you eventually close on one of them. The 200% rule lets you name more than 3 properties, but their combined value can't be more than double what you sold your property for. And the 95% rule lets you name as many properties as you want with absolutely no value cap. But then you have to actually close on at least 95% of the total value you named. Most investors use the 3 property rule because it's just simple. But if you're not sure which one fits your situation, this is exactly the kind of question your qualified intermediary should answer before day 45, not after. Next, whatever you do, do not touch your proceeds. Not for a day, not to hold it safely, not even for a quick cuddle. The money has to go straight from closing into the hands of an independent third party called a qualified intermediary, who holds it until it's time to buy the replacement property. If you take possession of that money, even briefly, the IRS treats you as having received it, and your entire gain becomes taxable that year. The exchange is over at that point. And the qualified intermediary can't be just anyone. It can't be your CPA, your attorney, your real estate agent, or anyone who's acted on as your agent in the past 2 years. It has to be an independent party with no other relationship to you. Qualified intermediary is usually the very first call you should make before you even list the property, not after you've already accepted an offer. So let's talk about like kind. A lot of owners assume like kind means trading a similar type of property for another similar one. A single-family rental for another single-family rental. That's not actually the rule, and it's more flexible than most people realize. Since 2017, 1031 exchanges only work for real property, not equipment or other personal property like they used to. But within real property, the definition is wide open. You can exchange an apartment building for raw land, a rental house for a commercial strip mall. As long as both properties are held for investment or business use, they count as like kind for each other. The one hard line is your primary residence. That never qualifies on either side of the exchange. Next, How to seemingly do everything right and still owe the IRS. It's called boot, and it's any value you receive in exchange that isn't like-kind property. The most common version is cash boot. If you sell for more than you spend on the replacement property, the leftover cash is taxable, and even though the rest of the exchange went through. There's also mortgage boot. If the loan on your new property is smaller than the loan you paid off on the old one, that difference can be treated as taxable income too. To keep it simple, so you defer all of your tax, you generally need to reinvest all of your equity and match or exceed your old debt with new debt. Anything less than that, and you'll owe tax on the difference, even inside an otherwise successful 1031. Next, what if the right replacement property shows up before you've sold your current one? In this situation, you can still defer your tax using something known as a reverse exchange, and the IRS has a specific safe harbor for it. In a reverse exchange, an independent party called an exchange accommodation title holder takes legal title to the new property and holds it on your behalf temporarily while you finish selling your current investment property. Once your sale closes, that property gets transferred over to you and the exchange complete. It's more expensive and more complex than a standard exchange, and it needs to be set up properly from day one, that is. But if you found the perfect property and you don't want to lose it, it's a real option. It's not actually a dead end. That's a good thing. Next, a real option to keep the deferral and lose the headache of being a landlord. If you're an out-of-state owner and you've owned the rental for some time, there's a good chance you're tired of being a landlord from a distance. The maintenance calls, the tenant turnover, managing all of it from another state. A lot of owners in that position think their only choice is to sell and pay the tax because they assume every 1031 replacement property means buying another rental to manage, and it doesn't. A Delaware Statutory Trust, or DST, lets you exchange into a fractional passive ownership share of a larger property, like an apartment complex or shopping center, or pick your pleasure of some commercial building. Anyway, as long as it's run by a professional sponsor, you still get the income and the tax deferral. You just don't get the 2 a.m. phone calls. An interest stake in a DST qualifies as like-kind replacement property. It's a legitimate, well-established option for landlords who want out of the day-to-day grind without giving up the deferral. Finally, one of the most asked questions I get is, can I 1031 into a place and eventually move into it myself? The answer is yes, but only if you follow specific IRS safe harbor and only after time has passed. You generally need to hold the replacement property for at least 24 months before converting it to personal use. During each of the first two 12-month periods, two separate rules apply. First, you have to actually rent the property out at a fair market value for 14 days or more. Second, and this is a completely different number, your own personal use is capped at whichever is larger. Pay attention, 14 days or 10% of the days you rented it out that year. If you rented the place for 30 days, for example, that year, you're capped at 14 days of personal use. But if you rent it out for 250 days, your cap jumps to 25 days, since 10% of the 250 beats 14. Skip this waiting period or go over your personal use cap too soon, and you risk the IRS deciding the property was never really held for investment, which can unwind the whole exchange. Every one of these rules exists to answer the same underlying question. Is this property genuinely being held for investment, the way the law actually requires? Get that right, and a 1031 exchange can defer a real tax bill indefinitely. Get any of one of them wrong, the deadline, intermediary, the boot, the paperwork, and you can lose the deferral entirely after you've already sold. This is exactly why the sale itself needs planning of the proper timeline ahead of time. I work with out-of-state landlords to build that timeline from day one alongside your CPA and qualified intermediary, so the deadlines aren't a surprise and the exchange actually holds up. Go to azabsentyequity.com and get your free property assessment, and let's talk about whether a 1031 fits your plan. I'm Matt Borkowski. Thanks for watching.